So, this is a little bit more of probably a little bit more sophisticated class. We're not going to be talking about the basics of how to do a real estate investment, because this is a group that probably is beyond that point. I don't know. I thought I'd just ask a couple questions right at the beginning and see exactly where you are and what you do. How many of you are real estate investors right now? Okay. And how many have not done any real estate investing? Okay, you two stay after class, will you? Just kidding. So we're going to be talking about real estate syndication, what that concept is. We're going to be talking a little bit about 1031 tax deferred exchanges. And then at the end of the class, I'd like to just share with you a few stories and give you some examples of things that I've done where I've incorporated 1031 tax deferred exchanges with a real estate syndication. But first, let me kind of introduce who I am. I'm president of the National Association of Real Estate Advisors. That's an organization that works with commercial real estate brokers, agents, and investors that want to do commercial real estate. I got a bachelor's degree in accounting from BYU and an MBA from the University of Utah. So if you're a Utah person, I'm generally conflicted on most games, whether it's basketball or football. But anyway, love both programs. I'm also president of our organization called the Overland Group, and that consists of 5 independently owned and operated companies where we do a bunch of different things. So a little bit about NAREI. This is kind of the sales pitch side of things, just to kind of let you know what we do. But we offer 2 basic types of membership. If you want to get on our website, which is nareigroup.org, you can sign up for a basic membership, and it costs you absolutely nothing. You'll start getting all of our real estate information and things that we do. If you want to get a little bit more involved in the program, you can actually sign up for a pro member, and that's $199 a year. If you sign up here at the show and put in a code, go to our website and put in a code called Summit 2019, we'll give you that for 25% off. So you can get it for $150 instead of basically $200. And some of the benefits, we do a monthly newsletter. We have all our normal media stuff, webinars, podcasts, blogs. Then we have affiliate partners like, I don't know if any of you attended Matt Sorensen's class, but if you were to sign up and do a directed IRA through them, you get a discount by going through our company. Then you can put a personal profile. If you're especially a broker that does this, you can put a personal profile on. You get discounts to our educational classes. We offer a designation called the Certified Commercial Advisor, CCA designation. It's a little bit like CCIM, except we focus more on the brokerage side than the investing side. And then you get free forms and checklists. And the next class I'm going to teach you about how to do, if you're attending that class, about how to do investment analysis. So, and we have all that available. And our company basically does construction, development, property management, brokerage, all the normal stuff. Plus we do some real estate short-term loans and work with other developers and builders that need capital short-term. So we have a bunch of investors that work with us on that. So let's talk about real estate syndication. How many of you have ever done a syndication? Awesome. You're with Neil, and you have done one too, so, or more than one. Yeah, so I just want to tell you this has nothing to do with the mafia. So let's get that straight to begin with. This is about real estate stuff. But there are some regulations that are involved. If you're doing real estate syndication, you're going to be involved with the SEC to some extent, because they regulate all syndications, public and private. Do we have somebody here that can be a timer? So we have, when do we get out of here? We're out of here at 3:30? 3:30. Okay, so we have 38 minutes. And so starting at 3 o'clock, every 5 minutes, raise your hand, and then when I get down to about 3:25, I'm going to stop. We're going to open it up for Q&A or anything anybody wants. So, okay?
Okay, so 3 o'clock every 5 minutes, I raise my hand.
I know.
Okay.
Yeah, and if I go beyond 3:25, just walk out. Okay. So the SEC regulates all securities laws, and you have to ask yourself the question, why in the world is a real estate deal a security? And real estate transactions by themselves are not securities. But most often when you're doing a bigger real estate deal, you're involved with some form of ownership, like a partnership or an LLC or a sub-S corporation. Those are all regulated by the SEC, so that's how they get you. Is if you put a real estate transaction in an LLC, now you fall under the guise of the SEC. So, and most of these syndications that we do in real estate, they can be public, they can be private. They either have to be registered or unregistered, or not unregistered, but exempt from registration. So if you're doing a real estate investment trust, that's a registered public offering, and that all relates to the public side of the business. What we try to do is do exempt registrations. She'd had enough, and I hadn't even got 5 minutes into the presentation. We try to have exempt registration, deals that are exempt from registration with the SEC. So to do that, 99% of the projects that want to be exempt from registration fall under the guidelines of what's called Rule 506 of Regulation D of the Securities Act of 1933. So we're really big on trying to be in compliance with Rule 506 of Regulation D. That's what it's all about. If you want to put together your own real estate deal and form an LLC, and it's not hard to do that, to be honest with you. You can get online, you can form a LLC, it costs you $70 to do that with the state. And get articles of organization is what they're called. And then you usually have to work with an attorney to get an operating agreement for that. But once you do that, you're in business. You can go out and buy or put under contract a piece of real estate. And then if you want to get a bunch of investors together, you can do that. But you want to make sure you try and stay in compliance with Rule 506. So here's the basic requirements. You can't do what's called general solicitation unless you work solely with accredited investors. Okay, we'll define that term in just a minute. So if you're working solely with accredited investors, you can go advertise, publish it everywhere, let people know what you're doing, and you're good to go. But as soon as you get somebody in there that is not accredited, then that's when the compliance issues can cause some problems for you. So a company may sell to an unlimited number of accredited investors or up to 35 non-accredited sophisticated investors. And so on any one transaction, if you wanted to put together a real estate syndication, form your LLC, put your real estate deal inside that, go raise equity capital, as long as you meet the accredited requirements, you can advertise anywhere. But if you don't, then you have to advertise only to those people that you have a pre-existing business relationship with. And so I went to the state securities division and said, okay, what's a pre-existing business relationship? And they said, well, friends and family count. I said, okay, how about the people that I've got on LinkedIn? And they said, well, we're not sure. Tell us about that. So I told them a little bit. And I said, I've got about 200 first-tier connections. I've got about 1,000 second-tier and almost 5,000 third-tier. They said, well, we think your first-tier LinkedIn connections would qualify as a business relationship, or even somebody that you've done business with and exchange business cards. It can be that loose. But they said, no second-tier connections, no third-tier connections. So I got pretty active a few years ago, and I capped out on LinkedIn at 30,000 first-tier connections. And so I have a pretty good network of people that I work with and do these deals with. So the next thing is, whatever you're doing, this is just good business policy. Always provide full disclosure. And so we work with a securities attorney, which I'd advise you to do, and prepare a private placement memorandum or private offering memorandum. They're the same document. But that'll get you going. All of that is probably going to cost you somewhere around $10,000 to $12,000, depending on who you use and what you do. If you're paying more than that, call me because you've got the wrong attorney. But $10,000 to $12,000. I've had attorneys quote me up to $50,000 to do this. You're from San Francisco, so you're going to pay double what it. Just take everything that I'm saying and multiply it by 2 or 3 times.
When it's all said and done, we typically pay 20, but that's with all of the filing fees and everything.
Yeah.
Quote tends to be 12.
So yeah.
12 and a half, but once, that's just what they say on paper. When it's all said and done, it's 20.
We're from Utah, we get better pricing.
I'm sure you do.
So, but yeah. Accredited investors are people that have a net worth of more than $1 million, excluding their home, or they make an earned income of $200,000 a year and have done for the past 2 years and are expected to do that again the next year. Or if you're a couple that's investing, then the threshold can go to 3. But it's not, you have to have $1 million and $200,000 a year. You just have to have one of the two. So, yes.
No, it's 3 o'clock. You told me to tell you every 5 minutes, right? Raise my hand. Or was that a...
That was a really dumb idea on my part, because I'm going to call on you every 5 minutes. No, that's good. Yes, that's good. It's perfect. But if I call on you again, you'll know I've lost it. Okay? So, any questions on the syndication side? That is a really quick overview. Yes?
Just a real quick one on this accredited idea. I put money into some deals, and I've been asked these questions, right? But nobody's ever verified, my answers, right?
Yeah.
And so I'm wondering, is this like, if you get investors in the fold that have said they are, but they're really not, can that get you in trouble? Or is it, as long as you ask those questions, you're probably,
No.
no.
It gets you into trouble.
Okay.
This is over our head now.
So is there some level of verification that it is typically recommended by the
Yes.
syndicate? Okay.
Yep.
Right.
You get yourself in trouble if you don't qualify. And so what we do is we have an investor qualification questionnaire that they're obligated to fill out, and then it has to be verified by an independent source like a CPA.
That's for 506C. For 506B,
Yes.
there's a survey that does not require verification by a third-party service.
Right.
But whatever the investor says on that survey, they are responsible for. So if you say you're accredited and you're not, and you try and come back later and say, well, nobody's proved it, that's on you, not on the syndicate.
Yeah. You've got issues if you don't verify. So it's always good to, if you're going to do one of these, always good to verify the investors. Yes.
Would it be good enough to have them send you a copy of like their tax return or something like that?
Some do that. We haven't required that because a lot of times they don't want to disclose how much they're worth, but, or give you all their tax information. So we've found that if they just get their CPA or, somebody that's, can verify that, then we have them do that. Third party, yeah. And that works really good. Any other questions? If not, now we're going to talk about 1031s for a minute, and then we're going to combine the two and try to see if we can make sense of how to do all of that. So on a 1031 tax deferred exchange, that's all regulated by Section 1031 of the Internal Revenue Code, and it allows an owner of an investment property to exchange property and defer paying federal and state capital gains tax if they acquire what's called a like-kind exchange. And a like-kind exchange, most of you haven't done a 1031, right?
I've helped with one.
Oh, you've helped with one?
I'm an agent.
Oh, you are? How'd that go?
Just fine.
Awesome.
She sold a lot and then bought a condo.
Okay,
Housing.
awesome. And I get questions all the time, well, can I sell my condo and buy something else? Retail property or land, or can I sell my land and buy an income producing property? The answer is yes. As long as it's real estate, it all qualifies. The thing that doesn't qualify is you can't sell a property and trade into an LLC. That is not a like-kind exchange. So even though you got that property sitting inside your LLC, that's not a like-kind exchange. So that's where it kind of gets a little tricky. And so you can exchange a business for a business. Yep. Yes.
So if I just have a piece of real estate that I put the ownership of that real estate into an LLC, and then I want to do a 1031 exchange to get some different piece of real estate, maybe one that I own individually instead of an LLC. Does that work?
Yeah. Ask this lady right back here. If you have an LLC, can you exchange into another LLC?
If it's your own LLC, I would imagine you can. It's the same name to the same name, correct? Are you talking about, are you saying?
Into a new LLC.
Yes, you do it through tenant improvement.
Well, yeah, so we're going to get into that in just a minute. But when you're doing a 1031 exchange, whatever name you're coming out of, you're going in that out of the what's called the replacement property. You're going into the relinquished property is the one you're coming out of and going into the replacement property. I have never run across somebody wanting to do an LLC into an LLC, and maybe that would be considered a like-kind exchange, but I don't have a good answer for you on that. It seems like a simple question, but most of the people that are doing deals with me are coming out of a piece of real estate and they want to go into a new development project or a new acquisition that I'm doing. And so they have their ownership, and it could be, they can own it any way they want, whether it's an LLC or a trust or whatever. They just have to, whatever they're going out of, they have to come into the new relationship under the same ownership. Yes.
Same one LLC,
Oh.
one LLC in one name, same LLC, I don't know, would be valid.
This is a bad idea. I've called on her twice. I'm going to call on her 4 more times before this is over. No, I like it. I feel like you're engaged. So, most 1031 tax deferred exchanges are handled through a 1031, or handled through what's called a qualified intermediary. There's some local people that do these things, and there's some national organizations that do them. 2 of the biggest that I'm familiar with are First American Exchange and Old Republic Exchange. Haven't done anything with Old Republic Exchange. I've done some deals with First American Exchange. And probably not Old Republic because they're not here in Utah. They're located in other states. Yes.
Old Republic actually opened up.
Who did?
Old Republic?
Oh, did they? So they're here. I just haven't done a deal with them. And if you go to their website, it doesn't show that they're doing business in Utah as an exchanger.
I know the title.
Yeah, the title company's here. So most people doing a 1031, there are 3 different rules, but most people that are doing a 1031 are doing it with this 3 property rule. And basically what that does is that just says you're going to identify 3 properties, like-kind properties, of equal or greater value than the one you're selling. And then you do that within 45 days, and then you're obligated to close within 180 days. And those are calendar days, counting holidays, weekends, everything. If you miss your date, you're toast. So it's really important to hit your dates.
I have a question about that.
Yes,
So I recently heard about a reverse 1031,
yes.
and I don't know anything about that. Does that,
A reverse 1031 is just the opposite of a regular 1031.
okay, so what does
Yeah.
that mean? Can you just breathe? Just,
Okay, so going into
thank you.
a regular 1031, you're coming out of a property that's not associated with the 1031, and you're doing a 1031 into a new property of equal or greater value. A reverse 1031 reverses that process. You're in a 1031 and you're getting out of it.
Okay, thank you.
And so, yeah. So, these transactions require the parties involved to meet all the applicable laws of the IRS and the SEC. So, they're more complicated. But if are any of you thinking about maybe doing a deal where you're bringing in other partners? Oh, several hands. Well, no wonder you're in this class. So, if you're doing that, you have to be in compliance with all of the rules for both the 1031 and the SEC. Now, I'm going to give you a couple examples of deals I've done where I mix it up and I've got a bunch of stuff. So, here's how we do it when we combine it. There are basically 4 things you have to adhere to, and then we'll talk about a couple examples, okay? First, the 1031 exchange investor enters into a purchase agreement with the LLC to buy a portion of the land or real estate. Yes. Well, we're 15 minutes down. So, the 1031 exchange investor works through a qualified intermediary. Same program. The 1031 exchange investor purchases a portion or fractional interest in the real estate. And then the last one, the 1031 exchange investor and the LLC enter into a tenant in common agreement specifying who owns what and how the deal works, okay? So let me give you a couple examples of that. I'm just going to throw in this one little tip before we do that. If you're a syndicator the sponsor of one of these investments and you want to do these and you're working with a 1031 investor that wants to put their money in your deal, it's always good if you get what's called a limited power of attorney, because they're going to be on deed on the property that you own, and you have to go back to them every time you want to do something and get a signature from them, whether you're borrowing money to do the loan, paying anything off, transferring the land into a deal, putting a first mortgage on the property. They have to sign off on all that. But if you get a limited power of attorney giving you the right to do that as the sponsor and the manager of the LLC, then you can generally handle all those transactions and not have to be chasing them down. I had one deal where a guy was on a cruise somewhere in the Caribbean, and we had to chase him down, and when he landed at a port, had to go find a place that he could sign documents, and they had to be original signatures, so then we had to FedEx them back to the States in order to get the deal done. So I learned that lesson the hard way. So here's a deal we did up in Helena, Montana. It was Staples store that had gone dark, and many of you know that Staples has done a lot of downsizing in the last few years. And they had a 25,000 square foot store. And we approached Big Lots. We didn't own it, but we thought it might be a good investment, really good location up there. And so we thought it might be a good investment. So we approached Big Lots to see if they wanted to participate, if they wanted to be our tenant on the property. And they said, well, if you can get us up to 30,000 square feet, we'll do it. And so we had to put a 5,000 square foot addition on the back of the property in order to do it. So we got this $5 million deal we're doing, raising about $2 million in equity capital. And we had a couple that owned a trust that approached us on doing a 1031, and they were coming out of a fourplex that they owned in Provo, not one of Fig's, but coming out of a fourplex, was tired of doing the management. Now they wanted to get a more passive investment, and so they did the deal with us. Well, their deal was about $700,000. They came in with $350 in cash, and they needed $350 in debt. And so we worked with our bank, which was US Bank, on the deal, and they said, sure, we can let them sign on the debt for $350 so they meet their debt requirement. And some of these are all cash deals. Some of them have debt with them. And if they have debt and you're selling a deal that has debt, the deal that you're going into has to have debt. So they came into the deal with us, but they could not be a part of our LLC. We actually had to sell them an interest in the property itself. And so they owned an interest, and our LLC owned all the rest. And then to blend those two together, we took the two parties and created what's called a tenant in common agreement, spelled out all the terms of what we were doing, and we became joint venture partners in the deal. And they owned a certain percentage ownership in the project, and our LLC owned everything else. That's kind of how they work. Any questions about that?
What role does somebody have coming into a syndicate besides their initial investment? Like you said, if the syndication, you want this power of attorney because you're going to get a mortgage. I mean, you could create such a debt structure does that put me at risk?
Yeah, so the question was, what risk is associated with one of those, and could that put me at additional risk? Because they may be coming out of a mortgage that's $350,000, and now we're going into a mortgage that's $3 million or more, right? And so, fortunately for us, U.S. Bank was willing to basically bifurcate the loan and say, okay, your portion is $350 and you're not responsible for anything above that, and the LLC is responsible for all the rest of the debt. So
If I sign a power of attorney for you,
if you sign a power of attorney and then I screw up your deal, you're toast. You know, if I do something that messes up your deal. If you don't sign a power of attorney, then I just go back to you every time we want to do something and ask for, you know, your signature on doing that. So you can retain that if you're a 1031 investor. Usually most people are not going into that deal unless they feel comfortable enough with the sponsor that they know that the sponsor's not going to take advantage of them or do something to jeopardize their money. Yeah.
I would say most sponsors wouldn't want to be in a situation where they have, every time they want need to do something, need to go back to that other person and get their
Yeah.
sign off on it. There's too many things that need to move forward
Yeah.
in an apartment building or whatever
Yeah.
the deal is. That would be,
In a short time frame. So yeah, that would be difficult. So okay, here's another example, and then I'll end with this. What's our time? How are we doing?
We're at 3:18.
So we're in good shape. Okay. So the second example, this was a self-storage project that we're doing in Woods Cross, Utah, 536 units. You know, it just occurred to me, let me say a couple other things. Do we have handouts of these projects? Where have we?
this project?
Yeah. No, not this project, of the deals that we're doing. They're right there?
Yeah,
We ought to put them somewhere, and let's put them in the back on some chairs. So if you want to get a copy of the deals that we're doing, this is just a 2-page, single, double-sided presentation, but you can get on our website and download the entire offering memorandum and everything. We have it on our Overland website, overlandcorp.com. If you go there, you can download that. And then this presentation, I've, because you only have 40 or 50 minutes to make a presentation like this, you don't get to cover everything that you'd like to say in a class like this. So we've put on our NARIA website, nariagroup.org. I've written a white paper, about 14 or 15 pages, on each subject that I'm teaching. And have we downloaded them yet?
not yet.
Okay, within the next day or two, they'll be downloaded onto our website. And you can get on there through the newsletter, in our media center, through newsletters and white papers. You can get on there and download that, no cost, and get a lot more information about what's going on. So this transaction was a ton more complicated than the previous one. That one we had one 1031 investor in. This one we had 3. And among the 3 investors, we had a total of just over $1 million of the equity capital we raised on this. So not quite half, but a lot of the equity capital raised on this deal was from 1031 investors. And so each of those investors owned a percentage ownership of the land that we were purchasing. Our land deal was $1.5 million, and we had us as an LLC and 3 other 1031s in there doing this deal. But if you're raising equity capital and you have a chance to work with a 1031, it's a little bit more complicated. but it's a pretty slick way to raise a lot of equity capital in a short period of time. The 1031 investor is motivated to get into something good and a property that's probably better than the one that they're getting out of. So these are good deals. And on this deal, say somebody came in for half of the ownership of the land, but it only represented 25% of all the capital that you were raising. Are they now a 50% owner in your deal or a 25% owner in your deal? That's kind of a complicated question, but the reality is even though they own 50% of the land, they only own 25% ownership of your entire deal because now you're building a new project on there. And so they don't get a 50% ownership in your whole deal. And all of that is spelled out in the tenant in common agreement. That's where everybody knows what ownership interests they have, how the whole deal works. And we go one step further and we create in the tenant in common agreement, we mirror the rules, regulations, and agreements that we have in our operating agreement for the LLC in the tenant in common agreement. So everybody in that tenant in common, all the parties are agreeing to the same thing. So does that make it complicated enough?
As a land lease to the,
No, it's a purchase.
no, I mean,
We don't, we,
overland storage.
no, we didn't lease the land. That is something you probably could do, but
The 1031s only own part of the property, do they own part of the buildings too?
yes.
Okay.
Yep. They own, and that's what I was trying to explain, is they own part of the buildings, but they own it at a lower percentage than the percentage ownership they had in the land. So yeah, they own a bit of the whole thing. A land lease would complicate the heck out of the whole process. You could do it with a land lease, but it's probably more difficult. And now with some of the deals, these three projects that we're doing, one's a 116 unit apartment deal in St. George in actually Washington City. And another one is, and the other two are in Mesa, Arizona. One's a 2-story self-storage project, and one is a 112 unit assisted living project. So we're doing different things and raising different investment capital for all three. They have different types of returns. And for the small one, the storage project, we're letting both accredited and non-accredited investors come into that one, and the minimum investment amount on those is $25,000. And the bigger deals, the apartment deal and the assisted living deal, minimum investment on those is $50,000, and those are just offered to accredited investors only. So we can do some general solicitation on those. So have I confused anybody? Is this something you want to do, or is this something you think like?
There's a lot, but it's really fascinating.
Yeah, this is not real estate 101. This is probably this might be considered more of a graduate level course.
So if I have, I have 8 properties in the Midwest that I want to get rid of.
Yes.
And I want to do a 1031. And the thing that's held me back on is selling them all at the same time within the 180-day period, right? It's not
Yes. Yeah.
in a situation like this, can I sell one at a time and increase my ownership in the new entity?
Absolutely. But the key will be the ownership interest that you get in the land, or the project. It'll be coming in one at a time.
Yeah,
So you'll wind up having 8 different ownership interests
that'd be,
in there.
that's
But yeah,
cool. And
yeah.
then for the management.
yeah.
And then from the QI standpoint, would he be doing a reverse
He'd be doing 8 separate 1031s.
So he couldn't back into it the other way? I guess it's easier just to do it the eight separate.
I think so. I think it'd be easier just to come in one at a time as you got them done.
That's what I did with the thing,
Yeah,
running 10 different.
yeah. You could do the same thing for something like this, yeah.
Yeah, it's paperwork for other people.
Yeah, that's right. But hey, that's why you hire an attorney, you know, otherwise what else are they good for, right? Yes,
You know, with the opportunity zone.
Yes.
Law now, how is that 1031, is there any advantages of doing it? Going to do the,
from what I understand, so the question was, in an opportunity zone, which is the new thing that's come up, which is you get some tax advantages if you're going into an area that's
opportunity zone, yeah.
having some income economic issues, so blighted, whatever the term is you want to use. So yeah, they will actually defer. What it is if you invest in an opportunity zone over 10 years, they will reduce the amount of your capital gain tax every year for 10 years until at the end of 10 years, if you've held the property in there, no tax. You completely eliminate the capital gain tax. So yeah, you can do those kind of deals. And I don't know all the ramifications of the opportunity zones because I haven't done anything in there yet, but I've been thinking about it.
Capital gains,
What?
yeah, in 2027, you have to pay 85% of the capital gains you brought in. So you have to look at the rules. It's the amount that of the gain during the process of a hold. That's what you get tax-free at the end of the 10 years. But the capital gain that you bring into the project, if you come in 2019, it's stepped down to 85% of that gain. So anyway, look at the details.
Well, what fun is that?
I know it's not fun to everyone's quarter.
The IRS giveth and the IRS taketh away, right? It's always that way. Okay. All right, well, we're in a minute or two. If there aren't any more questions, there's always somebody that doesn't want, I'm just kidding.
How are you soliciting for your new investors?
It depends on the deal that I'm doing. Okay, if I'm doing a small deal, like our self-storage project that we're doing down in Mesa, 2-story, that'll be about an $8 million project. We're going to raise somewhere around $2.5 million on that. And I'm going to accept both accredited and non-accredited investors into that deal. So we'll do a private placement memorandum, all the same stuff that we would normally do, regardless, to provide the disclosure. But I'm only contacting people that I have a pre-existing business relationship with. Now that's a big group. That's my 30,000 LinkedIn group. That's everybody else I know on NARIA or anywhere else. And so it's a pretty big group, plus all past investors and stuff like that. And now guess what? We now have a pre-existing business relationship. We can all get together and do a group hug up here if we want, but yeah, so that's what I'm doing with that one. On the other ones, I'm doing a major email campaign. We've, through a group called Info, it used to be called Info USA, now, they're now called Info Group, but they are a major player in the mass email marketing program. And we're doing a major campaign with them. They have identified almost 400,000 accredited investors throughout the United States. And we're doing an email campaign that started last Tuesday to 50,000 of those guys. And what they do is for the first week, they seed that potential investor group through Facebook advertising. So if you get Facebook ads showing Overland Group, you can blame me. But they do that to that group for about a week. And then they go out with email blasts. And they found that if they seed it with an email campaign first, then you get a higher response rate when they actually get your email, because they've already seen 500,000 impressions from them before. I mean collectively, not individually, but 500,000 impressions, and then we do 2 email blasts to them, and we'll see how that turns out. But yes.
How many syndications have you done?
Probably more than I care to count, but I've done, I started out working for a company as a financial planner when I got out of the MBA program, and they started doing real estate syndications back in the 80s. And then starting in 1987, I started my company, and I have probably done 30 or 40 of these.
How do you sell a property? Do you not? How do you sell a syndication?
It's easy. You're just selling an LLC, or you're selling an investment with a tick.
Sign off, or is
What?
what if one person wants to?
One sign off.
Huh?
You got to be careful how you structure your deal. You can't have one guy messing up the whole transaction. But we usually put majority rules in there. So, I mean, and I haven't had a lot of people that have balked at the idea of selling a property at a big profit. So that doesn't seem to be the issue. But I usually, we like to keep these long term. And what we normally do with our investors is, if we have any, we tell them, stay in it for 5 years, and if you want to get out, let us know, and we'll buy you out. It'll either be us, or I'll find another partner another investor that'll come in to buy you out if you want to get out. And I've had 2 or 3 of those, and within days, I've usually got another partner investor that wants to come in. So it really hasn't been a big deal, but for the most part, these are long-term investments. They like being in them, and they're just good opportunities. So, well, thanks. Appreciate the time.